Hello fellow intelligent investors. I'm sure you are all aware of Tesla's spectacular share price performance. In a little over a year, Tesla stock has basically increased over 8x in value. And one of the most well-known beneficiaries of this share price development was Cathie Wood and her US-based investment firm Ark Invest, as Ark Invest has been one of the largest institutional shareholders of Tesla, and probably the most vocal one, as well, as they have claimed that Tesla stock will be worth $3,000 a share in the future, by 2025 actually. However, Tesla's 2021 performance differs from the 2020 spectacular rise in value. Ever since reaching its peak in January 2021, the stock has performed less impressively, moving sideways most of the time, and the stock is actually still down from its prior peak. And interestingly, Cathie Wood has recently started selling Tesla stock. And not just a few shares, but she has actually drastically reduced Ark Invest's Tesla position. And as Cathie Wood has been one of the loudest voices when it comes to the future performance of Tesla's stock, this is certainly newsworthy. So what exactly is going on here? Well, let's find out in this video. Alright, so let's take a closer look at what exactly is going on here. How much exactly has Cathie Wood been selling? Let's head to Ark Invest's website to get an overview of all of the trades Cathie Wood has done over the last few weeks. And if we just focus on Ark Invest's Innovation Fund, ticker ARKK, then we can see that the firm has been selling Tesla on 5 occasions. Starting on the 8th of September, she sold 119,000 shares. She then proceeded to sell 30,000 shares the next day, and then another 70, and 40,000 the next week. And if you add up all of those transactions, then Cathie Wood has been selling around 330,000 Tesla shares over the course of just 2 trading weeks. And based on Tesla's current share price of $759, these shares are worth approximately $250 million. And if we now take a longer term view, it gets even more interesting. Take a look at this graph here, as it shows that across her 3 major investment funds, she has actually increased her exposure to Tesla earlier this year when Tesla's stock price was much higher. But then, starting in April, she has started trimming Ark's Tesla position and has done so more rapidly, more aggressively in September. Across all 3 funds, Ark Invest has reduced the number of shares owned from a total of 5.5 million to around 4.1 million. So over the course of around 5.5 months, she has sold 1.4 million shares, which again, based on Tesla's current share price, would be worth a cool $1 billion. So why has she been selling? Well, if you want the short answer, I don't know. If well-known investors buy a stock or add to a position, they basically do this for only one reason. They believe in the long-term prospects of the business. However, investors might sell or trim a position for all sorts of reasons. Maybe because of opportunity cost, as they have just been, they have found a more attractive opportunity with that promises better returns going forward. Maybe the story has changed, or their investment thesis is broken, or at least part of the thesis has been invalidated. Maybe the investor does not feel comfortable with the current valuation anymore, just to name a few of the reasons why investors might sell a stock. So let's take a closer look at Tesla's valuation. But before I consider Tesla's valuation, I think it is only fair to point out that Tesla still remains the largest, highest conviction stock in all 3 of the mentioned Ark Invest funds. So ARKK, ARKQ, and ARKW. And with that out of the way, let's consider Tesla's valuation. So is Tesla overvalued? Is this why Cathie Wood has been selling? Well, obviously there are different approaches you could take here. For example, you could take a look at Tesla's PE ratio, but I'm going to ignore Tesla's PE ratio here, which is absurdly high, by the way. But I'm also aware of the limitations of PE multiples, and I don't ever use the PE valuation ratio in my valuation work or analysis. So instead, I will do a quick napkin relative valuation here, and then I will do a reverse DCF valuation to figure out how much future growth has or is already priced in in today's stock price. So let me just very briefly give you an idea of what a relative valuation approach could look like. For instance, you could compare Tesla's revenues to the revenues of other car makers. You could compare Tesla's profits, so net income, to that of these competing car makers. And then you could compare the market cap of all of these firms. And this would be a relative valuation approach, which I don't find particularly useful, even though in this case, well, in the case of Tesla, it certainly shows how much is actually priced into the stock. Just look at the comparison of Tesla's profits, revenues, and market cap to that of the other 5 car makers combined. But then, of course, the Tesla bulls would point out that Tesla is not a car company, which you can agree with or you can disagree with. I don't really care, to be honest. But you could also consider the valuation of major battery companies like Panasonic, or maybe solar companies like Longi Solar. And Tesla would still seem expensive. And maybe just on a side note, if you are one of the bulls that claims that Tesla will be one of the biggest solar companies in the world, will be a major car insurance company, a battery company, a robo-taxi company, a SaaS business, and so on and so forth. Well, please let me know how much sales has Tesla actually generated in these divisions, in these spaces. Well, I can help you here and actually show you a chart of Tesla's current revenue broken down by different business segments, different business divisions. So even Tesla bulls have to admit that at least as of today, Tesla absolutely is a car company, and any rosy projections should at least be taken with a grain of salt. Now, to be fair, the fair value of a company represents the value of all future cash flows, discounted back to present value at some kind of appropriate discount rate. So of course, the current share price could be justified if Tesla is able to execute on all of its promises, and if software can unlock many new opportunities. So let's do a reverse DCF here. And maybe for starters, a discounted cash flow model, so a DCF, is a valuation method used to estimate the value of an investment based on its expected future cash flows. And I have done a very detailed reverse DCF in a previous Tesla video of mine, but let's just very quickly do it again and see what kind of growth is currently priced into the stock. And just so you know, as of September 17th, Tesla's shares trade for $759 a share. So if we head to Tesla's cash flow statement, we can see that the last 12-month operating cash flow was $9.184 billion. And capital expenditures, so CapEx, was $6.56 billion. So based on this, we arrive at a free cash flow of $2.624 billion. So if we plug that into our DCF model now and want to achieve a rate of a return of 10%, so we use a discount rate of 10%, well, then we need to assume growth of cash flows of 53% in the first 5 years and 40% between year 6 and year 10 to arrive at a fair value estimate of $755. And just so you know, we haven't implemented a margin of safety yet. And obviously, those are some incredibly high growth rates that very few companies can sustain. And by the way, we are also assuming that there is no further share dilution. And just so you know, capitalism is brutal. Let me just show you an old Buffett quote to highlight how hard it is to sustain these incredibly high growth rates. He once said, "We started by identifying the 200 companies with the highest net income in 1990. By 2000, only 162 of those companies were still around. Of those, less than 9%, 14 of 162, grew net income at a rate of 15% or more from 1919 to 1999. None of those 14 companies grew at a higher than 15% rate for the decade ended in 2009. So, is Tesla overvalued? Well, only time will tell, as unfortunately we cannot travel to the future. But I think I've made very clear that I think it is indeed very likely that Tesla is overvalued. So is this why Ark Invest is selling quite a significant portion of its Tesla stake right now, despite its $3,000 a share price target? Again, I don't know. But personally, my impression is that Ark Invest follows a fundamentally different investment philosophy than I do. and most people who follow Warren Buffett kind of investment approach. To me, Ark Invest is phenomenal when it comes to marketing its own products, but they are certainly not fundamentally driven investors. And you can certainly see this very critically, like this tweet here shows. But I'll leave that assessment up to you. I am absolutely not a Tesla expert, and I've actually never done a deep dive on the company, as I'm simply not interested in owning a highly capital intensive car maker. But from what I can tell, Tesla's fundamentals have certainly not become worse over the last few months. Revenue is up, operating profits are up. It seems like Tesla can sustain its profitability. The firm was actually able to increase the number of delivered vehicles, and they have also increased their market share in the BEV market. So that's battery electric vehicle. And this is actually something that Cathie Wood herself expressed when she was recently interviewed by Yahoo Finance. Let me just show you a short clip of that interview.
So that original number was on the old stock. We've had a 5-for-1 split. So our new number, our base case for Tesla with this on the split stock is 3,000. The stock right now is a little over 700. On the old basis, that would be 15,000. So what that tells you is our estimate for Tesla's success has gone up. And the main reason for that is their market share, instead of going down from year-end 2017 to today, has actually gone up fairly dramatically around the world.
On the other hand, you could argue that this level of execution by Tesla and its management is more than priced in right now. And if you know how capitalism works, it should come as no surprise that competition in the EV space is also starting to heat up and here to stay. In fact, Elon Musk himself seems to agree with me here, and he very recently tweeted the following. To be fair, investors are giving us significant credit for achieving self-driving, given that Tesla's valuation, production is very high compared to other automakers. So again, why did Cathie Wood sell? Well, maybe the decision is indeed based on fundamentals and she has some kind of special insights in terms of certain supply chain shortages. Or it's just a result of Ark Invest's trading style, which is generally more active. There's a lot of buying and selling and profit taking. And the investors seem to make decisions based on momentum metrics. In fact, earlier this year, Cathie Wood said on CNBC that when there is hype around a stock, quote, we naturally just take profits because we know we're going to get another opportunity associated with controversy to buy the stock lower. So the bottom line is that investors can only speculate why Ark Invest is trimming Tesla so aggressively and whether they will continue to do so in the coming weeks and months. So let me know in the comments down below what you think. And with that, I think we can wrap it up here. Make sure to check out some of my other videos, and may your finances and investments prosper, of course. Good luck.